Imagine you are looking at two different investment properties. One is a busy retail space, and the other is a multi-unit apartment building. How do you accurately compare their value, beyond just their asking price, to truly understand their income-generating potential? The answer lies in a powerful technique called income capitalization. This method directly values a property based on the income it is expected to generate, making it a cornerstone for serious real estate investors. It helps you understand what a property is genuinely worth as an income-producing asset. At its core, income capitalization reflects the principle that investors purchase future income streams. Therefore, the value of an income property is directly tied to its net operating income and the perceived risk of that income. The capitalization rate, or cap rate, is the key ingredient here, converting that income into a current market value. Let us walk through the steps to calculate property value using this essential approach. First, you start by determining the property's gross potential income. This is the total annual rental income if every unit were occupied at market rent for the entire year, before any vacancies or expenses. Next, you will subtract an allowance for vacancy and credit loss. Not every unit will be occupied all the time, and sometimes tenants might not pay. Subtracting this estimated loss from your gross potential income gives you the effective gross income. Now comes the crucial part of identifying all operating expenses. These include items like property taxes, insurance, utilities if paid by the owner, property management fees, and maintenance costs. Remember, do not include debt service or depreciation here, as they are not operating expenses for this calculation. When you subtract your total operating expenses from the effective gross income, you arrive at the net operating income, or NOI. The NOI represents the property's cash flow before considering any financing costs or income taxes, showing its true operational profitability. The final piece of the puzzle is the capitalization rate, often called the cap rate. This rate is usually derived from recently sold comparable properties in the same market. For example, if similar properties are selling at a 5% cap rate, you would use that. A good real estate professional or appraisal report can help you find this critical market data. With your net operating income and the market cap rate, the calculation is straightforward. You simply divide the net operating income by the capitalization rate. So, property value equals NOI divided by the cap rate. This formula gives you a strong, investor-focused estimate of the property's value. Understanding how to apply a market-derived cap rate is an insider advantage, as it factors in local investor sentiment and risk assessment. For instance, a property with a net operating income of $100,000 and a market cap rate of 5% would be valued at $2 million. However, if the market cap rate for a similar, riskier property were 10%, the value would be $1 million for the same NOI. This clearly demonstrates the cap rate's impact. It is vital to meticulously forecast your operating expenses, because overestimating income or underestimating expenses can dramatically skew your valuation. Also, remember that debt service, which is your mortgage payment, is not part of the net operating income calculation. The income capitalization method focuses on the property itself, not how it is financed. Mastering income capitalization empowers you to move beyond surface-level observations and truly assess an investment property's intrinsic value based on its income generation. This foundational skill equips you with a robust framework for making confident, data-driven decisions, ultimately helping you build substantial real estate wealth with clarity and precision.